So I can come back here and do my forecasts for my working accounts. And I'll have to reverse this days measure to get back to a cash measure for the balance sheet. So as a percentage of 2015's revenue, I am going to hold 7.6 days worth of 2015's revenue as cash. All right, so revenue divided by 365 gives me how much revenue per day is earned, and then I'm going to hold 7.6 of those days as cash, as operating cash. So my operating cash goes up slightly because my revenue goes up slightly. Again, we'll come back to excess cash. We'll look at inventory as a percentage of cost of goods sold. So I'll take my cost of goods sold here, divided by 365. That's how much cost I incur every day. And then I'm going to have 182 days worth of that cost sitting in inventory. So I have $54 worth of inventory on hand. Now on the liabilities side, I have my accounts payable, again as a function of cost. So this is my cost per day. I'm going to multiply that times my accounts payable forecast driver. So 81 days worth of those costs are still owed in any given year. Multiply by -1 to make that positive, and my accounts payable go up to 24. Now I won't forecast short-term debt here directly. We'll come back to it. So let's look at our operating balance sheet items. Now we don't have any accounts receivable for this firm, so we won't forecast accounts receivable. We have our inventory and accounts payable done in terms of days. This is just doing it in terms of percentage. There shouldn't be any difference here. We don't have any accrued expenses for the firm. Sorry, let me keep it up here. But we do have net PP&E, and net PP&E is one of the trickier things to forecast. We'll talk about it more in the lectures, but here we're going to choose to forecast it as a percentage of revenue. So in other words, if I'm going to produce more of whatever it is I'm producing, let's say bicycles, then I need to have more fixed assets the more units I sell. So at some point I'm going to need to have more machinery, bigger factories, all those kinds of things to produce more product. And this is where the hang-up comes. The hang-up comes because I don't grow, while my revenue might grow organically at a steady percentage, my net PP&E is unlikely to do that. In other words, I'm not going to buy 20% of a new machine in the following year because my revenue grew by 20%. I'll use my machinery until its limit, and then I'll make a big purchase of a new machine and jump my PP&E by a big amount when I need it. So we say that net PP&E probably grows in lumps instead of smoothly. And this is what we'll talk more about in the lectures, about whether there's different ways to forecast this. But we'll just choose to forecast it here as a percentage of revenue. So we'll say that net PP&E in 2014 as a percentage of revenue, that our net PP&E here, oh, and I can make this a percent and give you, is 104.2% of revenue. And so we can make that forecast in 2015. Can say that we'll need to grow our revenue sufficient to justify produce more product and keep our net PP&E as a function of revenue going forward. Now again, I told you we don't forecast equity investments, so our growth in equity investment is just 0. So we don't have a growth rate here, so I'm just going to drag this, keep it at 100. Then our total assets here will be a function of any amount of excess cash we have, our operating cash, our other current assets, and our total assets. So this would be the sum of these items. So we'll do that temporarily. Notice that we don't have the amount of excess cash, and we did have $60 in excess cash here, so we're going to have some excess cash unless we've spent it, but we'll temporarily sum for our total assets. We're not going to forecast debt changes specifically, so we'll keep short-term debt. the same. And I'll just drag my sum over here so that the new sum is totaled. We're not going to forecast, again, long-term debt directly. We're going to let the numbers tell us whether the firm needs any new debt. So newly issued debt here and excess cash are going to make up something called the plug in an analysis. And the plug is a result of our forecasts. Okay? So if the firm needs new debt, we won't forecast a growth rate in debt. We'll say if the firm requires debt, we'll plug it here. Again, we don't forecast common stock growth either. If the firm wanted to raise equity financing, it would do so in a big lump, not as a growth percentage. Now, retained earnings we'll do directly here. Retained earnings should flow from the income statement through what's called the statement of retained earnings. Now, most of these are results, so our starting retained earnings is our previous year's ending retained earnings. So this here is equal to our 2014 ending retained earnings. This is what we would expect. Now then, our income statement is going to give us our net income for 2015, our forecasted net income. And our dividends declared, we are going to keep our dividend rate the same. Oh, yeah, take this. We're going to keep our dividend growth rate the same here, and you'll see how that works here. So we're going to say that the dividend payout policy, and this is, remember, net income gets split into dividends and retained earnings. So our retained earnings is going to grow by any amount that's left after we pay the dividends of the firm. Right? And our dividend payout policy, again, we're going to assume that it stays the same. So we're going to say, I've got my net income in 2015 forecasted, and if I keep my dividend payout policy the same, then I will pay 45.8% of my net income out as a dividend in 2015. And since that's a payout, let's make it a negative. Right, so I have starting retained earnings of 82. I bring in some net income, 58.8. I pay out 45.8% of that net income as a dividend, and my finishing retained earnings is the sum of this. Right, so my starting plus my net income minus my dividend payout. Oh, you know what? What am I doing? I do this for a reason. Let's just sum it all. That's why it's all there. And my retained earnings now is going to be equal to my retained earnings here. Okay, so this is what I mean by reconcile the income statement and the balance sheet. Retained earnings should flow naturally in here, and that should help balance the balance sheet, right? And one of the things that is going to happen here is that the retained earnings is the firm's savings account. So this is cash that I didn't spend on any costs and that I didn't make any different investments in that I know of, right? And that cash has to go somewhere. Okay, so let's talk about where that cash might go. I got my tentative sum of liabilities and owner's equity. Right? And now notice that we have a problem. Oh, whoops, I dragged that up too far. Right? I had already included the sum here. So, okay, now notice that I have a problem. My balance sheet doesn't balance. Right? I have total assets equal to 460. I have total liabilities and owner's equity equal to 495.9. Now, why does my balance sheet not balance? It's because of this retained earnings. I added all this new cash to the owner's equity side. I added all this to my savings account. And this cash, it has to go somewhere, right? If I don't spend it on buying new fixed assets, for instance, right, some of this cash could go to buy fixed assets, but it hasn't. I have increased net PP&E, but not by enough to say that I still have money left over. So that's where excess cash here and newly issued debt here come into play. These are called the plug, and the plug is what balances our balance sheet at the end, right? So the money that the firm generates from operating cash flow, this extra retained earnings, it is going to need to go somewhere on the asset side, And if it's not going to go to an increase in PP&E or maybe purchasing some equity investments or something like that, it's got to go to excess cash. Right? If, on the other hand, I had total assets that exceeded my total liabilities, then I would need to raise money. That would mean my assets grew more than my owner's equity and liabilities. And the only way that happens is if I brought in financing. So the plug would go into newly issued debt. So the way I calculate my plug, very simple. What's the difference between my asset side and my liability side? $35.9 needs to go in to my cash account. And when I plug that in, I get a balance sheet that is equivalent. That means my newly issued debt account is 0. So my plug here comes from my excess cash. It comes from retained earnings. I put that extra money into the savings account as cash, and I plug my cash balance sheet. And you can see that all of that tracks with the solution. Here's a more explanation here of what the plug is. This is what the extra credit is on your in your homework 4. If you can automate the process of doing the plug in each of your years, meaning if you can come up with a function that automatically calculates what the plug is without doing it manually, then I'll give you some extra credit. If you can't or don't have the time, just do the plug manually, and that's the only thing in the homework 4 sheet that can be hard coded. Okay, good luck, and of course, as always, if you have questions, you can just send me an email.